Welcome to the Dealmakers Coffee Break. I'm Asaf Raz. Let's go. Welcome to another episode of the Dealmakers Coffee Break edition. And today I have someone that we've actually been chasing for a while. Sorry for all the emails, Jeremy, but this is Jeremy Hill from JB Capital. He's been in this industry for over 21 years, maybe even more, recognized for his expertise in the private debt industry. And I think going into 24, this is a very promising asset class. Jeremy, I'll let you take it away. Tell us a bit about yourself, your company, and we'll continue from there.
How are you, my man? Good to see you.
You too.
You too. To share some time. So thanks for the chase, and I'm glad it is that we get to spend a few minutes. So
of course,
I'll give you a couple seconds on us, and then looking forward to diving in and talking a little bit further. So I've got a company called JB Capital. I am the J and the B, so pretty good looking, but maybe not that smart if that's all we came up with on marketing, right? But we had historically started as an investment bank and a capital markets advisor. We're really good at solving problems, and most of those problems had something to do with money. And when you're banking, your rich uncle, wouldn't call you back. Some guy told you to talk to us. And so in the early 2000s, when we started the business, we were doing predominantly real estate transactions that morphed into more asset-based securities, which turned into, oh, goodness gracious, corporate debt, securitizations, and a number of things, but really all focused on this kind of lower middle market. So a little bit better than $1 billion in transactions over that period of time. Really in what we call the in-between, right? The stuff that's past the friends and family, mom and dad, rich uncle round of raising money, but not yet to a point to where institutional capital can really afford to pay attention. And we just got really, really good at that. A few years ago, we started our first fund. We're now on fund 3. And business is continuing to grow and do good things. And we're both excited and scared of the market it is ahead, and hopefully looking to do good things that help some people and make some money along the way. So
that's amazing. That's amazing. And I love the history and the background and how you literally doing I feel like you're part-time doing heavy funds for different asset class investments, but also distressed. And we'll talk about that. How do you deal with distressed assets or distressed developers or GPs? Yeah. Just because we are looking at the trends for 2024, we know what's coming. I believe this is going to be one of the biggest trends for next year in terms of debt strategies, exit strategies. We have about 50% of the market going into debt maturity this year in 24, right? So we're going to have all those things to deal with. And knowing all that, I'd love you first to cover what you think is going to happen in the industry. Obviously, we don't know how to expect it exactly, but what you're seeing in terms of the trends. And then what is your strategy going into 24?
Sure. Oh, there's a lot to unpack there. So what are number one, what are we seeing and what are we thinking is going to happen? Right. And then number 2, what's our response to that, and how are we, what are we doing internally? It is to plan for that. So I think what it is that we're hearing and what we're continuing to see is this kind of rise in interest rates. It's caused everybody to be uncomfortable across, both business and personal areas of their life. We are hearing about this kind of impending maturity cliff. I think it's scheduled to start, any day now, the end of this year, beginning of first year through the end of 27. And so for those of you listening that are, not reading every paper it is that's out there, is that you've got roughly 2.5-ish is what they're saying, $1 trillion in basically commercial securities that are coming due into a maturity wall that if, you and I, Asaf and Jeremy's 2 wise guys, construction development, whatever it is that we are, right? We had a property it is that we bought, invested, built, developed, whatever it is 10 years ago. Well, 10 years ago, we're in a 3.5%, kind of cost of capital. Now we're maturing into a world to where we're going to be 7.5, 8. So we're something different. And when you change the economics like that on a project, more often than not, they don't work, right? And so if we move into this world of kind of a maturity, now it's okay, what the hell are we going to do? If my cost of capital goes from X to Y, or if my car payment just went from $500 to $2,000, well, shit, I don't know if I want that car anymore, right? That's really expensive. And so the big concern it is that people are having is both from a lender standpoint, an owner, investor, and developer standpoint, and an LP standpoint, how is everybody going to be affected by that? And the reality is everybody is going to be affected by that. What's going to be the catalyst it is for that affectation, though, is going to be ultimately in how it is that the banks and the lenders and those holding that security respond. You're going to see some banks it is that have the balance sheet, and they're going to play the lender game of extend and pretend, right?
Yeah.
There's a monster under the bed. I'm just going to pretend like he's not there, and maybe he'll go away, right? And we'll wait 6 months or a year or two or later, or I don't want to do anything, so let's just see what happens. There's going to be a lot of folks it is that don't have that flexibility. The lender, the investor doesn't have the balance sheet to do so. He can't afford to keep something on his books that's either underperforming or non-performing or not performing at all. And they're going to be forced to sell what under normal circumstances would be a good quality performing asset at either a discount or something else. And so the reality is I think it's probably half and half. Even if we have a, whatever the number is, 2.5, even if we have a $2.5 trillion maturity cliff, it's not going to be all or nothing. It's not going to be all or going to completely go to hell and everybody's going to buy stuff at a discount. And it's not going to be every, bank and investor it is that says, we're just going to kick this can down the road. There will be extraordinary opportunities for folks.
Yes.
There are extraordinary opportunities that's going to be coming from an extraordinary amount of discomfort on somebody else, right? So that is kind of that's what it is that we're seeing. I think it is that it's different in my mind from what it is that we saw in the great financial crisis in 2008 that was affected more around the world. Because we were at that period of time, it is the United States was basically, putting whipped cream on dog crap and selling it as caviar to the rest of the world, right? It's not happening like that anymore. But there is a real affectation of these interest rates it is that are going to cause people some hate and discontent for sure.
Yeah, and we did hear that some voices saying, it's going to happen in 23. Whatever is not in a fixed rate debt and has floating rate debts is going to fall quicker than the others. And what I feel like we're seeing right now are two things. I see this tug of war between sellers and buyers, right? There are people in the market with cash ready to deploy, and they're just waiting because they understood what's going to happen, right? And then there's people that are holding the assets, and they're used to a 2 years ago, 1 year ago price they can sell it for. But when they'll get to the reality that there's no profit in the asset and it doesn't make sense to hold it anymore, they can't sell it for that price. Yeah. So I feel like there's this tug of war, and I see that. I actually hear that from brokers who are saying, I'm trying to both reduce rents and reduce the price of a sale for a building with the sellers and try to work with them to come to a point where they can do it for lower. And the GPs are just waiting. The investment firms that have money, they're just waiting. A lot of them, by the way, are also, I'm hearing a lot of land investments, long-term land investments. I'm hearing a lot of triple net lease. A few things that can still work within this industry, but that's the one thing that I'm seeing. And then the other things that I'm seeing is different than 2008. In 2008, lenders and borrowers didn't work together. It was essentially, you either pay me the money or I take the property, and then the banks are like, wait, I'm stuck with so many properties I can't do anything with them. And this is where I feel like here things are coming in. I'm seeing lenders going towards taking on better debt or finding solutions together with the borrowers on getting better debt terms, making longer refinancing options, right? To find a way for them to continue to run the deals, because eventually a lender doesn't want a property, right? How are you seeing this trend coming together, especially on the lender borrower side?
I think, I do think fundamentally it's exactly where you said when you start, is there is still a disconnect between investors and property owners it is that are believing it is that they should still justify a price it is that's 18 months or 24 months old. Well, 24 months ago, we're in the interest rate environment it is that we are at now. We're also not in a geopolitical uncertainty that's affecting everybody around the world, right? And these are all different decisions it is that people are not taking into context when they're trying to primarily when they're trying to sell their building. Investors, buyers are absolutely taking that into effect, saying it is, interest rates have gone from X to Y. Here's what's going on around the world. Here's the uncertainty in the future, and I'm going to price that in. And that chasm between your thinking and my thinking, right, kind of a thing, is the bridge that I think people are going to be forced to come over. I think the pressure obviously is going to fall more on those it is that need to actualize and realize capital, which is going to be the sellers. If I'm trying to buy your property and you and I are at a fundamental disconnect about what the price is, that's fine. I'll call you at the end of the quarter, right? It's not going to become less uncomfortable in the next little bit, right? And so, I don't know. That's kind of what it is that we're seeing there. And then further evidence to that, when we're beginning to see some of the largest guys from like we saw Buffett just move 3 or 4 big positions to cash like 2 weeks ago, something like. And for historically a big long-term investor to take some of his, stable assets it is that he's had forever and ever never moved to cash, why would he do that? Well, he would, my guess is, and again, there's plenty of people listening to this that are smarter than me, but my guess is that if you're moving to a world of cash, you see discomfort coming, which is going to equate to an extraordinary, buying opportunity, right? I mean, you and I both know so many people that did so extraordinarily well coming out of GFC, whether it was public equities, in a market that went from, plus or minus 20,000 down to 7. Mm-hmm. So you had buying into the public equity markets at 7 that 3 or 4 or 5 years later were back at 21 and they were brilliant. You weren't brilliant. It was cheap, right? And so
it was free money.
Totally. Yeah.
Yeah. Yeah. And I also see, this is funny, actually 5 hours ago, PRE News put out an article talking about ex-Blackstone real estate boss Chad Pike, and turning to the market right now with investment firms to capitalize on current market opportunities. So I feel like this is constantly going to happen. We're going to see this happening again and again. So you're going to, I assume, going to continue to focus on debt, right? Specifically, or more in your core of your business. Just how would that look like working with the market right now and with these type of new investment firms or existing investment firms looking to deploy cash? How would that look like for new buyers or people that are kind of moving in the market?
Yeah. And so I think one of the things that we've seen over the last 3 or 4 months and we'll continue to see over the next year is everybody now is a distressed real estate investor, right? And so we're going to see a lot of those funds pop up in anxious anticipation of what is to come, right? And I think you'll see it continued, in my mind, and not to be a cynic, but I think you'll continue to see a continued consolidation of power. It is for the largest guys, it is that will raise, 75 to 80% of the money. And the rest of us poor schmucks like me, it'll all be fighting. It is for the balance of that 20%, right? But you're going to continue to see, the Apollos and Carlyles and BlackRocks and these guys, it is continue to raise gobsmacks of money and make a big dent in that market through kind of a consolidation of acquisition and power.
Is that going to be mostly debt, mostly cash, you think, these type of deals?
Yeah, I mean, they don't have any trouble raising money is what it seems. It was interesting to me is Apollo had a SPAC that they had raised maybe a year ago, and plus about $5 billion it is that they weren't able to deploy, that they ended up turning around and giving that cash back, which, for an asset manager to give cash back is, usually there's an opportunity that's better for them. Any of these guys it is that you saw raising SPACs, and, once it is that they had the money committed, they'd go buy something, even if it was a dog, right? And so for them to turn money back, well, again, somebody knows more about it than I do, but I think that there's going to be some extraordinary opportunities. You're going to be a bunch of guys that are focusing on distressed debt, on distressed assets. I think the majority of people are going to be equity focused rather than debt focused. For me, the way that I look at the world is I look at the world through a debt landscape. Doesn't mean it's right or wrong. It just means how it is that we view the world. And so when I'm looking at that, there's ways it is to organize and structure debt to where you get equity level returns but still having all of the protections of being a lender, right? And so one of the things it is that we've talked about before is I look at debt like a bit in a horse's mouth, right? So with that little 8-ounce piece of steel, it's in a horse's mouth, I can control a 2,000-pound horse, right? I can him up, slow him down, turning left, turning right, stick his ass back in the stable. It doesn't matter. I don't have to own the horse to control the horse. That debt is a function of maneuverability and control. And so if we do that correctly, then I like how it is that is. So for us in this market going forward, we're we have two sides of our house. Our corporate credit side, it is to where we're investing and loaning into, growing technology and healthcare and health tech and direct to consumer and professional services businesses. For your audience, our real estate strategy really is isolated to multifamily and industrial assets only. I'm not a huge fan of office and retail and land development and ag. I know that there's strategies that work there. I just don't understand them and don't want to learn, right? Mm-hmm. So I stay in my lane with multifamily and industrial. And when I'm looking there, we're looking at kind of preferred equity structures. Mm-hmm. Because what it is that we've seen is this general deleveraging across banks and agency balance sheets, to where if the two of us, two wise guys development, if we were going to go buy something or build or develop or invest or otherwise, a year and a half ago, that was, 70 to 72% leverage. If we had a big balance sheet, that went to high 60s, mid 60s, low 60s, high 50s. Agency business, even for stabilized assets, is 50. Wow. And so now, even for the most experienced developers and sponsors with a good balance sheet, that's painful, man. Yeah. Right? If you're bringing $30 to the table and now you're bringing 40 or 45 or 50, it's not that you don't have, a lot of these guys, it's not that they don't have the extra capital, they do. It's just, it's tied up in the other 20, developments it is that they own, right? And traditional banking is not, they're not that smart, right? They don't, and honestly, they don't need to be, right? You don't need to take too much risk when you're loaning paper at 6% money. Mm-hmm. So you're going to see a big continued move to the alternative capital marketplace, whether that's private equity, private debt, or otherwise. What we have known as alternative lending for the past 15 years, soon enough, it's just going to be lending, and banks are going to have a smaller and smaller part of that going forward. And so I'm hugely bullish on what it is that we're doing and what you guys are doing and what a lot of your audience is doing in this private marketplace. I think there's a very long, successful road ahead. I'm excited about it.
That's a great conclusion of this. And I have to keep us on the 20-minute rule. So here's the last question I always ask. I call it the shameless plug. This is where you get the opportunity to talk about your current investment opportunities, what you're working on today, reaching out to the audience to see if anybody's interested either in your services or you're looking for something specific. This is your place to, really shamelessly say what you want.
Oh, shameless plug. I should have come up with a t-shirt or something. Damn it. Really for us, two things. We have a deficit to demand on capital. We can conservatively probably put out $1 billion a year, and we're not raising money that fast. Regardless of how good looking and smart I am, we're not raising money that fast. And so we're looking for some larger partnerships it is. And so we've been to New York, London, and a couple places it is, trying to figure out a different way it is to do more with less. I would say that that's one from an investor standpoint. We've got an extraordinary organization, good technology backbone, audited returns from day one, like all the stuff it is that you want, we have. Mm-hmm. From the developer standpoint and kind of partnership standpoint is people are looking for unique sources of capital it is that can be flexible and catalytic to their efforts. And oftentimes one of the things that is that we've seen in the market it is from sponsors is they have a very narrow approach. I've got vanilla ice cream. I'm going to sell it to everybody it is that I want, even if you don't like vanilla ice cream, right? And so we like to be able to come in it is with a flexible mandate in how it is that we're structuring capital to make sure it is that we can have a positive effect on Joe, the developer or builder and investor, and help them get to their point B. So the shameless plug it is for us is we've got an extraordinary organization, but we're always looking for more money and better partners. And then from a developer and borrower standpoint, if you want somebody that actually sits down that needs to understand your story and help you get to the finish line, we're your guys.
Appreciate it so much, Jeremy Hill. Thank you so much for joining me for this episode. It was
great to share some time with you, buddy. Be safe. We are praying for you.
Thank you so much. Thank you for joining us. Check out more episodes on the Dealmakers podcast, available on Spotify, Apple Music, Google Podcasts, and Agora's website at agorareal.com/podcast. See you in the next episode.